On Thursday, May 6, 2010, at 2:32 in the afternoon Eastern Time, the Dow Jones Industrial Average began a fall that would become legend. Over the next several minutes, it plunged about 998.5 points, roughly 9%, in one of the most violent intraday swings in its history, a swing of about 1,010 points. The whole episode lasted around 36 minutes, and traders later named it the crash of 245. For a few terrifying minutes, by estimates that are widely cited but approximate, something on the order of $1 trillion in market value simply ceased to exist. This did not happen on a calm day. Fear over the Greek and European sovereign debt crisis and uncertainty around the UK election had markets jittery, and by early afternoon major indices were already down about 4%. The VIX, Wall Street's fear gauge, closed up 31.7% that day to 32.80, and at its intraday peak it spiked far higher, to a level that, had it held into the close, would have ranked among the largest single-day jumps on record. Regulators later described the crash as unfolding against a backdrop of unusually high volatility and thinning liquidity. The room was already full of gas. It just needed a spark. At 2:32 p.m., a large mutual fund firm, later reported to be Waddell & Reed of Overland Park, Kansas, launched an automated program to sell 75,000 E-mini S&P 500 futures contracts, worth about $4.1 billion. This was not malice or panic. It was a routine hedge against an existing stock position. By itself, the order was modest, just 1.3% of that day's total E-mini volume of 5.7 million contracts. The danger was not the size, it was the instruction. The selling algorithm was told to target an execution rate of 9% of the trailing 1-minute trading volume, with no regard to price or time. That phrases the whole story. The machine watched only how much was trading, never how far prices were falling. The same firm had once sold a block this size over more than 5 hours. This time the program dumped it in about 20 minutes. Here is the trap hidden in that rule. As selling pushed volume up, the algorithm read the higher volume and sold faster, which pushed volume up again, which made it sell faster still. There was no break tied to price, so falling prices did nothing to slow it. The E-mini S&P 500 dropped about 3% in roughly 4 minutes, and the SPY Exchange Traded Fund fell about 3% right alongside it. The future shock had jumped straight into the cash stock market. High-frequency trading firms first absorbed the selling, buying contracts and building up positions they did not want. Then, to cut their risk, they flipped and sold aggressively, passing the same contracts back and forth among themselves. Between 2:45, 1:3, and 2:45, 2:7 p.m., a window of just 14 seconds, they traded over 27,000 E-mini contracts, about 49% of all volume, while buying only around 200 net. The New York Fed concluded these firms did not trigger the crash, but their responses to the unusually large selling pressure exacerbated the volatility. Enormous activity, almost no real liquidity. As prices cratered, the traders whose job is to always quote a buy and a sell price, the market makers and HFTs, withdrew to assess their risk. The order books emptied. Liquidity, the ability to actually find a buyer, vanished in seconds. And when a sell order arrives and there is no real bid waiting, it falls until it hits whatever is left. What was left were stub quotes, placeholder prices nobody ever expected to trade. The results were surreal. 8 major S&P 500 stocks briefly traded at 1 cent a share, including Accenture, which fell from about $40 to a penny, and CenterPoint Energy. At the other extreme, shares of Sotheby's, Apple, and Hewlett-Packard spiked to around $100,000, with Sotheby's printing near $99,999. Procter & Gamble, a household blue chip, dropped nearly 37%. SEC Chair Mary Shapiro pointed to those stub quotes as the cause of the penny prints. The price of a stock had briefly stopped meaning anything at all. What helped stop the spiral was almost absurdly small. At 2:45, 2:08 p.m., the Chicago Mercantile Exchange's stop logic functionality paused E-mini trading for just 5 seconds. In that tiny gap, the relentless sell pressure eased and buyers came back to the table. When trading resumed at 2:45, prices steadied and began to climb. Regulators credit that 5-second pause as a pivotal circuit breaker, working alongside the broader return of liquidity that followed. The Dow had shed about 600 points in 5 minutes, hitting its low near 247 with a loss close to 1,000 points. Then it reversed nearly as fast as it fell. By about 3:07 p.m., most of that 600-point drop was recovered, and prices had largely converged back to true value. Afterward, exchanges canceled the most extreme trades, more than 20,000 of them representing about 5.5 million shares, any that executed more than 60% away from their 240 price. Critics called that 60% line opaque and arbitrary. If you were stopped out at 50% down, your loss stood. After about 5 months, on September 30th, 2010, the SEC and CFTC released a 104-page joint report. It identified a large institutional sell program executed without regard to price as the trigger that started the cascade. The firm behind it was separately reported in the press to be Waddell & Reed. Critics argued blaming a single order was too simple. 5 years later, that doubt found a focus. In April 2015, London trader Navinder Singh Sarao was charged over a spoofing and layering scheme he was running that morning, placing large fake e-mini sell orders he repeatedly modified and canceled. Authorities framed his conduct as a contributor to the order book imbalance, not the sole cause of the crash. He pleaded guilty, was sentenced in January 2020 to 1 year of home detention, and a separate CFTC order required him to pay more than $38 million in penalties and disgorgement. The crash exposed how fragile a fast, fragmented, automated market had become, and the fixes still govern your trades today. Regulators banned stub quotes, built single stock circuit breakers that evolved into the limit up, limit down price bands, and rewrote the market-wide circuit breakers to halt trading at S&P 500 drops of 7, 13, and 20%. They added a market access rule forcing brokers to put risk checks on algorithms before they reach an exchange, and built the consolidated audit trail to reconstruct events across every venue. These are the guardrails standing behind the modern market. If your retirement savings, your 401k, or your index fund sits in the stock market, the flash crash is your story. It showed that prices you trust can detach from reality in seconds when liquidity disappears, and that automated rules can turn a routine order into a market-wide collapse. It is part of why a market order placed in a panic can fill at a wild price, and why limit orders and circuit breakers exist. Analysts warn the same automation-driven fragility persists as algorithms and AI expand, so the lesson endures. In a stressed market, liquidity can vanish faster than any human can react.